Welcome. Today is Thursday, November 16th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights, and this is your Daily 5. Today, we're going to introduce a couple of concepts with respect to sentiment and market breadth, as well as take a look at how we see the market setting up going into year end. Before we get into that, let's just a quick public service announcement for those watching. With respect to our monthly newsletter, as some of you may know, we do publish a monthly newsletter entitled Huge Insights, The Big Picture. This is a free newsletter to subscribe to via Substack. You can access it at hugeinsights.substack.com. Put your email address in, and it will be delivered to your email box the first Saturday of every month, typically following the non-farm payroll report. The newsletter basically focuses on key macro factors affecting the economy and the markets, but we do oftentimes get requests for more from clients and readers, and those who do want more have an option to upgrade to paid for as little as $12.50 a month, which actually includes our monthly market forecast and positioning recommendations. The upcoming newsletter, which will be published on December 2nd, will focus on a couple of things. Number one, we think the U.S. economy entered recession on November 2nd, and we are going to discuss all of the reasons why we believe that is the case in the newsletter. We also are going to go through a big expose on the bull case for gold going forward. So for those of you gold bugs out there who want to get our take on gold, it might be worth subscribing and upgrading to paid. Paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. This is an institutional publication that we make available to newsletter subscribers, which details our top actionable trade idea each week and also provides updated market commentary. That comes out every Wednesday afternoon. In addition, paid subscribers also will get access to some privileged quarterly video content that we don't generally put out on YouTube or the internet, and also periodic interim bulletins when we've got something to say between regular scheduled publications. So with that said, let's jump right into our first slide, which is kind of reviewing market sentiment, investor sentiment. You know, at this point, we see investor sentiment as clearly neutral. Measures have reversed from a level of extreme fear as measured by the Fear and Greed Index. That actually reached 22 at the October lows. We've now advanced to about 55 as of today, which is a clear neutral reading, in fact, on the upper end of neutral. And, you know, the Fear and Greed Index is really a compilation of 7 different indicators, typically short and intermediate term indicators that measure some aspect of stock market behavior. They are market momentum, stock price strength, stock price breadth, the put-call option ratio, junk bond demand, market volatility, and safe haven demand. And so what the index does is it tracks how much these individual indicators deviate from their averages compared to how much they would normally diverge. And the index gives each indicator equal weighting in calculating a score from 0 to 100, with 100 representing maximum greed and 0 representing maximum fear. So at 55, we're a little bit over dead neutral, somewhat favoring the greed side. And we think this is consistent with what we believe is a topping of a counter trend advance. And we'll get into that in just a few minutes here. Slide number 2 focuses on a recent breadth study that we completed. This looks at the advanced decline lines for a number of different indexes. Now, the cumulative advanced decline line is kind of a running measure of accumulated net advancing issues. And in this particular study, we can observe this measure across the quality spectrum. We've divided it into S&P 500, NYSE Composite, and the NASDAQ Composite. And the way we kind of look at this is that the S&P 500 represents the highest caliber of quality across that spectrum. You know, for all practical purposes, it's a house built of bricks. The NYSE represents a slightly lesser caliber of quality, but still, you know, not bad. This is a broad swath of of different market caps of stock, but a lot of high dividend payers in there as well. So we put it kind of in the middle, and we describe it more as kind of a house of sticks or twigs, if you will, in the three little pigs sort of perspective. Finally, we look at the NASDAQ composite, and the NASDAQ represents the lowest caliber of quality. These are typically non-profitable companies by and large. Bear in mind, the NASDAQ composite has about 3,600 stocks in it. So, not just the NASDAQ 100 that everybody has come to know as being, the highest quality growth stocks in the NASDAQ, but just a much broader measure. And as you can see, this looks more like a house of straw. Certainly while each has bounced off of its October lows, none of these AD lines has recovered sufficiently enough to suggest any sort of a new durable expansion in market breadth is among us at this point. Nor has any posted a new high to confirm the resumption of a bull market advance. Indeed, while all remain below their respective July peaks, the New York Stock Exchange and NASDAQ actually remain well below their 2021 all-time high. So in looking at this measure, we can conclude that while breadth is no longer at its nadir, it is certainly far from giving us the signal of all clear in the market at this point. Another breadth study that we're focused on right now in chart number 3 is looking at the momentum of breadth, or the so-called breadth thrust. And the most reliable breadth thrust indicator that we've studied is the NYSE Moving Balance Indicator. This was developed by a guy by the name of Humphrey Lloyd back in the 1960s. He detailed the system in his 1976 book entitled The Moving Balance System. And without getting too deep into the weeds here, the MBI measures the momentum of the 10-day moving average of net advancing issues on the New York Stock Exchange. So typically, when the MBI exceeds 85%, it's indicative of a very powerful surge in the market's breadth, and has in the past historically marked the beginning of every durable advance in the S&P 500 dating back to 1965. So far, the MBI has yet to even match the strength that it achieved off of its October 2022 low. And so we are not putting too much stock in the so-called breadth thrust that we've heard so much about on Twitter over the past couple of weeks. Indeed, even the percentage of S&P 500 stocks trading above their 50-day moving average has fallen short of the move that was experienced off the October 2022 low. So that being said, we don't necessarily see enough evidence in these breadth studies to confirm that anything more than a counter trend advance is really underway at this point. Chart number 4 is a 2-year performance review looking at a broad swath of very important key market indices. And why are we looking at 2 years worth of performance? Well, if we look at the broad market, looking at the vast majority of stocks, the broad market topped back on November 8th in 2021, okay? Now, how do we measure the broad market? Well, there's a few ways we can do it. We can look at the Russell 2000, which peaked that exact day. Another way would be to look at the Value Line Composite. The Value Line Composite is an index of approximately 1,700 US companies, which represent about 90% of all of the revenues generated by all publicly traded companies in the United States. So those 1,700 stocks include all of the S&P 500 stocks, including the Magnificent Seven. But this index is equally weighted across 1,700 stocks. That index peaked on November 8th, 2021. And so if we use that as kind of the peak and take a look at how everything's performed since that, the only asset that's really added any value whatsoever over that period of time is cash. Cash is king. We're looking at the Bloomberg 1 to 3 month Treasury bill index, which is up about 5.7%. Growth stocks are down over 3%. Value stocks down almost 4% over that 2-year period. Large cap stocks are down around 4%. Quality stocks are down over 6%. Foreign developed stocks are down 7.5%. The average stock, as measured by the equal weight S&P 500 index, is down over 10% in the last 2 years. Mid-cap stocks are down 12.5%. Micro-cap stocks down 13%. Emerging market stocks are down 19%. And small-cap stocks are down almost 20%. The worst performer by far are bank stocks, looking at the KBW Bank Index, which is down almost 41% over the last 2 years. This is indicative of what I would describe as anything other than a bull market. Okay, a sideways market, perhaps at best. Okay, looking at the biggest cap stocks. But certainly in the smaller cap area of the global market, we are in a bear market, no doubt about it. And likely poised to move much, much lower. And why do I say that? Well, let's look at chart number 5. Chart number 5 comes back to the Value Line Composite Index that we just described. Again, this index is equally weighting approximately 1,700 stocks that represent 90% of the revenues generated by all publicly traded companies in the United States of America. This is the best representation of the stock market. And we're looking at the geometric index, which basically prints the median return effectively on a daily basis. So every daily price change is the median return of the 1,700 stocks. And so when we look at this index, we can see, the clear top. That top was made with a 5-wave advance. And since that top, we see a very clear Elliott wave pattern. And that Elliott wave pattern is a clear impulse. 1, 2, 3, 4, 5. In fact, wave 3 divided perfectly into 5 waves as well. So, which is very, very typical, where we get the third wave extension and that more pronounced sort of 5-wave impulse pattern that's very discernible. And so we've illustrated that as 5 waves down at intermediate degree of trend for each one, culminating in an impulse wave that represents primary wave 1 down. Now, since primary wave 1 bottomed in October of 2022, we saw a 3-wave advance trace out an ABC zigzag pattern, retracing just shy of 61.8% over the subsequent 6-month period, which is pretty typical, about 2/3 of the time it took the market to decline. And so when we think about this index, it's really representing a very clear Elliott wave pattern. Primary wave 1 down, primary wave 2 up. Since that time, we saw another decline into the March lows, which we're counting as minor wave 1 down, of primary wave 3 down, and an ABC zigzag corrective waveform that peaked in July. We're counting that as minor wave 2 of intermediate wave 3 down. And since that time, we saw another 5-wave decline into the October 2023 lows. This is the October 27th low that we saw just less than a month ago. And we're counting that as minute wave 1 down of minor wave 3 down of primary wave 3 down. And so what we're looking at right now is the counter trend advance likely representing minute wave 2. This is an interesting piece of information for technicians out there. Just kind of following this very normal retracement process off the 2022 declines, the Value Line Composite has violated both its 200-day and 200-week moving averages, in addition to breaching the trend support level off of the 2022 lows, which also tagged multiple touch points on the way up. And so, Moreover, I would also say that the 200-day moving average has now crossed below the 200-week moving average and is now pointed down. The violation of these key technical levels suggests to us that the broad U.S. equity market is in the very early stages of a structural decline, and that the Elliott wave analysis that we just described calls for a significant and immediate decline to new bear market lows, and likely to take out the COVID lows that were achieved back in March of 2020. So how does this translate to the S&P 500, which is the index everybody wants to focus on? Well, it doesn't really translate very well. And the reason for that is because the concentration of just 7 stocks in the S&P 500, those being what are now commonly referred to as the Magnificent Seven: Microsoft, Apple, Google, Amazon, Nvidia, Tesla, Meta. Those stocks account for 29% of the S&P 500. And as a result, they have kind of warped the construct of the way the market would normally trade. And so the Elliott waves are less clear in the S&P 500 cap-weighted index. However, if we look at the S&P 500 equal weight index, taking the emphasis off of that concentration and giving them no more weight than we would give, any stock in the index, we then can see a very clear Elliott wave pattern off of the July 27th high, which again we mark as primary wave 2 up. And so we believe we're in the midst of primary wave 3 down. So far, we have traced out intermediate wave 1 down into the October 27th low. We can see each and every twist and turn in this index at minute degree, minor degree, and ultimately intermediate degree of trend. Since the October 27th low, we have now traced out a clear ABC zigzag corrective waveform, which has stopped exactly at the 377 bar simple moving average. Why 377? It's a Fibonacci number. We take note that many Fibonacci moving averages have significance, and we believe that the 377 has some specific significance at this point. We believe the market topped yesterday, November 15th. And we think that's significant for a couple of reasons, and we've talked about this in the past. November 13th was a key Montgomery cycle turn date. We use that date, the 13th, plus or minus 2 trading days. So yesterday was +2. There's another key Montgomery cycle turn date that comes into play on November 27th. We expect the market to trade down to new lows on or before that November 27th, plus or minus 2 days. That is kind of our current view of where the S&P is headed, and we think the setup is decidedly bearish going forward into the end of November. With that said, if you'd like to connect with us and follow up, you're certainly welcome to look at our website, www.jwhinvestment.com. You can follow us on Twitter at @alpha_insights, or sign up for our newsletter at Substack. That's hugeinsights.substack.com. Give us your email address and we'll put you on the distribution list. You'll get the next newsletter on Saturday, December 2nd. With that said, I want to thank everybody for watching and wish you the best of luck trading.